If I were to ask you the performance of any two stocks in your portfolio, then there's a high probability you might get one of them wrong. Why? Because while you would have remembered the increase or decrease in the share price of those stocks, it is very likely you would have ignored the dividends. In fact, half of the companies listed on the Indian Stock Exchange with a market cap of over 100 crores declared a dividend last year. This number jumps to 2 out of 3 for companies valued at 1000 crores or more, and even higher in the 10,000 crore plus category with 3 out of 4 companies offering a dividend. As a matter of fact, the top 10 dividend paying companies in India shelled out a total of 2,06,000 crores. Yeah, that's right. 2,06,000 crores in dividends in the last financial year, which is certainly not a number worth ignoring. So we won't ignore it and will actually work upon it and examine how different dividend strategies can be used to improve your investing portfolio and returns. If you've been a bit casual about dividends, as I have been in the past, then I'm sure you will find this video very useful. Let's begin. Now, what may surprise you is that until the 1940s, so this is not India, this is the US. So in the first half of the 20th century, there was a very simple way of looking at the two primary asset classes, that is debt and equity. So if the dividend yield, that is the dividend per share divided by the share price, if this percentage was higher than the yield offered by a government bond, then investors would purchase equity, otherwise they would invest in a government-backed debt instrument. But then from 1950 onwards, the dividend yield started to decline on account of a reduction in dividend payouts, and especially in the 1980s when the SEC offered incentives to corporations to repurchase their own shares. In fact, I love this image here that shows the proportion of dividend yield and buyback yield, as it explains something that we investors generally ignore, that is, your total return on investment is not just an increase in the stock price, but it also has other components including the dividend and buyback yield. Now, as of 2023, the S&P 500 offers a dividend yield of 1.7% and a buyback yield of 2.9%, which gives us this hidden return of 4.6% that I hope going forward none of you will ever ignore. As a matter of fact, and since 1926, dividends have contributed approximately 32% of the total returns for the S&P 500, and it's a number that has gone as high as 50% and as low as 15% in some decades. Now, obviously, I could not find such vast information on the Nifty, but the last 10 years of data shows us that about 18% of the total returns on a standard Nifty 50 SIP is actually attributable to the dividends received. We can even try this on a stock basis, and while the tables have turned a bit, here's how ITC Limited has fared over the last decade. So on a capital appreciation basis, the stock has gone up from 220 to 440 rupees over 10 years, which gives us a CAGR of 7.2%. But then ITC has also rewarded shareholders with almost 90 rupees in dividends, which gives us a total return CAGR of 10.6% had we reinvested those dividends in buying even more shares in ITC Limited. So to put this together, and a major lesson here is that the total returns of any equity instrument is the summation of its capital appreciation and its dividend yield. Now, when I talk about dividend strategies, I am not referring to keeping a bunch of stocks in your portfolio and passively earning income from them as dividends. I mean, yes, chasing dividends can also be a good strategy, but in this section, I'll be putting a larger emphasis on building a strong investing portfolio with the help of dividend as a strong selection tool. I think this will get clearer as we move ahead in this video. So there are two major investing strategies that I want to talk about: the high dividend yield strategy and the dividend grower strategy. Let's start with high yield, and as the name suggests, it's a number, a percentage that explains how much a company pays out in dividends each year relative to its stock price. For example, at the time of recording this video, one share of Castrol India was being traded at 113 rupees, and this company has paid out a dividend of 6 rupees 50 paise for the financial year 2023. So 6.5 divided by 113 gives us a dividend yield of 5.8%. Now, 5.8% is not a small number, and when I looked at companies above a market cap of 10,000 crores, I could find only 14 more companies that match this yield or offer something higher. Now, understandably, a high dividend yield depends on dividends, which in turn requires the company to generate profits and free cash flows, which can be quite cyclical. For example, here's a table where I have mapped out the annual dividends offered by companies that are generally high on anyone's dividend payout list. Now notice how some companies, especially in the metal, oil and gas space, have reduced their dividend per share on account of lower profits. Likewise, the Steel Authority of India offered zero dividend in some years as its financial position was not sound. And there are also companies like Coal India, REC, Power Finance, Oracle Financial Services, and Castrol India which have been consistent dividend payers. But what we are more interested in are the dividend yields, and here's where the inconsistencies are wider, because it's not just the dividend we have to factor but also the present valuation and economic climate. For example, you see a big jump in FY21 dividend yields, although many companies have actually reduced their dividend payouts. This was entirely on account of depressed valuations due to the coronavirus pandemic. But even otherwise, you are likely to see many ups and downs, which makes the prediction of future dividend yields a more difficult exercise as compared to estimating the future dividends of a company. It's an important point and something we'll see again when we talk about dividend growth strategies. But let's try to gather some more information around dividend yield. Now, my first instinct was to look at mutual funds, and there's a category called the dividend yield funds. On the face of it, everything seems good. There is a good spread of schemes, about 9 of them. The AUM totals to almost 15,000 crores. Some of the funds have been there for over 10 years. And in those 10 years, the schemes have definitely done better than the Nifty 50 index. But the problem for me starts when I look inside those funds, especially at the portfolio. And what I found is that most of these supposedly high dividend yield funds are actually invested in low dividend yielding stocks. I mean, look at this table here. So between HDFC, ICICI and SBI's offerings, there are barely 3 or 4 companies that have a dividend yield of over 3% in this list. In fact, one of the stated objectives of HDFC's dividend yield fund is to target companies that are available at 1 or 2 times of the 10-year GSEC yield, which is definitely not happening in this case. So if you're looking at mutual funds, then please be clear about this part, because what you think the scheme does and what the AMC actually does might be 2 different things. Now, given this quandary, I decided to move away from actively managed funds and I came across something passive, which is the Nifty Dividend Opportunities 50 Index. To put it in bullet points, this index comprises of 50 stocks. It selects from within the top 300 companies. It looks at the trading frequency. There is a stock weight capping of 10%. It's rebalanced quarterly. And of course, companies are ranked as per their annual dividend yield and are selected per a defined methodology. In terms of the portfolio, this index definitely has a few high dividend yielding stocks, which is also evident when we compare it to the Nifty 50, although on a performance basis and even on a volatility basis, I don't see too much of a difference. And finally, there are custom portfolios that one can find on small case, and there are a bunch of them out there. A lot of them are paid, so I won't get into these. But to put the concept together, I think picking stocks purely on the basis of a high dividend yield may not be the ideal approach to stock selection. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released and also share with you some investing strategies, tips and stories that I continually post in the community section. Alright, so let's look at an alternate dividend investing strategy. Now, it's often said that compound interest is the 8th wonder of the world, and this statement does have something to say when it comes to dividends. For example, an investment of 1 lakh rupees in a company that offers a dividend yield of 3% and whose share price remains constant at 100 rupees would have added up to 2.8 lakhs over 35 years. But now let's say we have another company which is not only paying us a dividend of 3%, but because it is in an expanding industry and it's able to grow its profits, this company's share price is going up by 3% and it's also been able to raise the dividend rate by 3% each year. So basically the compounding effect is happening at 2 places. One, when the dividend per share itself is going up from 3 to 3.09 to 3.18 and so on. And secondly, when the dividends we receive are being reinvested into buying more shares in the company, and that too is growing in value. Which brings me to the concept of dividend growers. And this is what I want us to really understand in this video. So dividend growth stocks are ones that can potentially increase their dividends in the future, and these are different from high dividend yield stocks that we discussed earlier, which may or may not increase the future dividend rate. In fact, studies done in different markets show that dividend growth stocks do better than high dividend yielding stocks in bullish, bearish, and neutral markets, and they tend to offer higher and less volatile returns against most other strategies. Now, the most popular dividend growth strategy are the Dividend Aristocrats. This royal sounding phrase is actually an index that seeks to measure the performance of S&P 500 companies that have followed a policy of increasing dividends every year for at least 25 consecutive years. In essence, the Dividend Aristocrats exhibit both capital growth and dividend income characteristics as opposed to just dividend yield or purely capital appreciation. Now, I won't go into the methodology or portfolio or sectors of the Dividend Aristocrat Index, but as the strategy very proudly says, it has delivered higher returns with lower volatility when compared to its benchmark, which is the S&P 500. Incredibly, the ability of these stocks to increase dividends for 25 consecutive years has not come at the expense of a lower dividend yield, and the S&P 500 Dividend Aristocrats have consistently delivered an yield that is higher than its benchmark. In fact, the aristocrats are currently at a dividend yield of 2.5% as compared to the S&P 500, which is at 1.8%. The other interesting point here, and these are the kind of things that we as investors should think more about, which is the Dividend Aristocrats are amongst the few stocks, or it's a strategy that actually exhibits growth and value characteristics. So obviously the growth comes from the increase in dividends and the share price, while value shows up in the form of a high dividend yield and lower price multiples, which is something we saw glimpses of when we compared the Nifty Dividend Opportunities 50 index with the Nifty 50. Okay, now that I have mentioned the phrases dividend yield, price multiple, growth and value a few times, it's important to put this in the perspective of factors. If you're hearing the word factors for the first time, then please do watch my video on the future of index investing, where I've discussed a number of factors with a lot of supporting data. Now, I raise this point on factors because while you and I might think that the Dividend Aristocrat strategy does well because of an increase in the dividend per share, what I think is actually happening accidentally is that these dividend stocks are getting exposure to other relatable factors like value, quality, price to earnings, volatility to value ratio, free cash flow, etc. And it's the impact of these factors on the dividend growers which ends up improving the portfolio outcome in terms of returns and volatility. It's an important point, and just to substantiate, there is in fact a decent amount of academic research that has demonstrated that even the plain and simple dividend yield metric, when combined with other factors like volatility, quality, momentum size, etc., can potentially deliver returns in excess to what a market cap weighted index might offer. Now, in Indian scenario, we don't have any mutual fund or ETF that is based entirely around the Dividend Aristocrat concept. However, I did find a small case which is actually being offered free of cost, and it includes companies like Asian Paints, HDFC, HUL, ITC, Marico, Pidilite, Infosys, etc. I even did a quick check on the dividend per share offered by each of these companies over the last few years, and yes, there has generally been a consistent and increasing trend of dividends there. Likewise, I found another small case, but this one is paid, and what I think this one does is to take the high dividend yielding stocks and it applies a number of factors on top of it. Factors like low debt, management record, price earning, valuation multiples, etc. So I hope you can understand where I'm coming from, and if you want to dig deeper into the subject, I have also attached a few resources and reading materials in the video's description. And if you're looking for a list of stocks, I found a couple of articles on economictimes.com that might be of interest to you. The first article is on 10 high dividend paying stocks, and understandably these are high dividend yielding stocks. And the second article, which was published in 2021, is on Dividend Aristocrats, and it features not one, not two, but 20 Indian companies that have consistently grown their dividends over the past 20 years. Incidentally, each of these 20 stocks had delivered a CAGR of over 15%, which again proves that a dividend growth strategy is certainly worth our consideration. Alright, so we've learned a couple of things. One, a dividend growth strategy is potentially more superior than a high dividend yield strategy. And secondly, one can combine different factors with either of these strategies to deliver superior returns with less volatility and better downside protection. Now, as a corollary, I would want to add that all dividends are not created equal, and this inequality often shows up in the way it is sourced. For instance, if the dividend is being paid from the company's cash flow from operations, then it's a healthy scenario because it means the setup is self-sufficient. However, if the company has to borrow or raise capital to finance the payment of a dividend, then it's not a great situation to be in, and the payout can never be guaranteed. So when you're doing your research, always make that distinction between a high quality and a low quality dividend payer, which can be done by examining the net profits, the cash flow from operations, and also the free cash flow. In fact, there's a term called the dividend value trap, which is a situation where an investor gets impressed with a high dividend yield number, but he or she fails to recognize the stagnation or decline in the company's operating business model. To avoid a scenario like this, do examine the company's return on capital employed. And if this is above the cost of capital, so let's say it's consistently over 14-15%, then you are less likely to fall within the dividend value trap. So these were a couple of additional insights I could find while researching for this video, and I hope you apply it during your research. Net, let's not be under the misconception that dividends are just a means of earning passive income. And now through this video, we also know that dividend growth can be a powerful stock selection criteria and that it can immensely improve our portfolio returns. I sincerely hope you found this video informative and will draw many learnings from the data and insight presented. Thank you for your time. Do like this video, share it with your friends, and I'll see you 3 days from now. Until then.